So welcome to all of you Shiksha 360, and today basically we will discuss chapter number 13 part 3, clear operational risk. Clear. So in this session basically we have to discuss some numerical formulas also related to the topic. Clear. So let's start our session. So first of all, basically in the previous session basically we have discussed regarding the three approaches. Clear. Basic indicator approach, TSA, that is the standardized approach. Third one is the AMA, clear, advanced measurement approach. Clear. Basically we have also discussed that is the first two approaches are basically on the income generated based, and the third one is basically on the operational loss measurement. Clear. Third approach is basically based on the operational loss measurement. Clear. So now basically we have to discuss in detail regarding all these approaches one by one. So first one is the basic indicator approach. Clear. That is the basic indicator approach. Clear. So what this approach says that? Basic indicator approach. Clear. So the banks using the basic indicator approach. Clear. Basically banks using the basic indicator approach, BIA. Banks using the basic indicator approach basically must hold capital for the operational risk. Clear. Basically how much capital? Clear. Basically must hold capital basically for the operational risk is equal to the average over the previous 3 years of a fixed percentage. Clear. Basically is equal to the average over the 3 years of a fixed percentage, that is 15% of positive annual gross income. Clear. Of positive annual gross income. Like basically we can say that basically if you are able to find it basically in 2022. Clear. Basically what is must capital basically you want to hold, that is basically 2019, 2020, 2021. Take average of that and take 15% of that also. This much is the capital basically you have to hold. Clear. Basically you must have to hold. Clear. Under the basic indicator approach basically for the operational risk management. Clear. Basically you have to hold under the basic indicator approach basically for what? For the operational risk management. Clear. Basically for what? For the operational risk management basically this much capital basically you have to hold. Clear. So basically banks using the basic indicator approach. Clear. Basically banks using the basic indicator approach basically must hold capital for the operational risk equal to the average over the previous 3 years of a fixed percentage, that is 15% of positive annual gross income. Like basically we can say that in this year they have not positive annual gross income. Clear. So basically we have to remove this year, and in the place of that basically you have to take year 2018. Clear. And check that. Clear. Basically whether they have positive annual gross income or not. Clear. If it is fine, or if it is positive annual gross income basically in the year 2018 basically, then basically you have to take that. Otherwise basically we will look forward basically towards the 2017, 2016. Clear. As per the condition. So figures for any year. Clear. Basically figures for any year in which the annual gross income is negative or zero. Clear. Basically figures for any year in which the annual gross income is negative or zero should be excluded from both the numerator and denominator basically when calculating the average. Clear. When calculating the average. Clear. So gross income. So what is defined as gross income? You have to remember that. Clear. Sometimes basically they will ask one mark question. Gross income, it is defined as net interest income plus net non-interest income. Clear. Net non-interest income. Clear. So basically what gross income is defined. Clear. Gross income basically it is defined as the sum of. Clear. Gross income basically it is defined as the sum of net interest income plus net non-interest income. Clear. So gross income. Clear. In simple language we can say that gross income is defined as net interest income plus net non-interest income. Clear. So it is intended that this measure should be gross of any provisions. Example for unpaid interest basically be gross for operating expenses. Operating expenses basically include fees paid to the outsourcing service providers, or exclude realized profits or losses basically from the sale of securities in the banking book. Clear. Basically we have already discussed what is banking book, what is trading book. Clear. And what is off balance sheet items under the chapter number 9. Clear. So you have to remember that. Clear. Basically what is banking book and what are the different types of risks. Clear. Basically what are the different types of risk basically included under the banking book. Clear. So can anyone tell market risk? As basically we have already discussed under that. So market risk is included under the banking book or not? Please tell fast. Market risk is basically included under the banking book or not? Clear. So please tell fast what is the answer of that question. Clear. Market risk is included under the banking book or not? Clear. So basically exclude realized profits or losses from the sale of securities basically in the banking book, exclude extraordinary or irregular items as well as income derived from the insurance, clear, as well as income derived from the insurance, clear. So basically all these things, clear, basically it should be measured, clear. It is intended that this measure should clear under the gross income, clear. So one question that is basically which I asked, market risk, it is not included under the banking book, clear. It is not included under the banking book, clear. So you have to remember all these things here. Basically just you have to remember that gross income, basically it is the sum of the net interest income plus net non-interest income, clear. Gross income, basically it is simply the sum of the net interest income and net non-interest income, clear. And it should be basically under the basic indicator approach, basically 15%, clear. 15% of the average of the previous 3 years. So basically please tell this question, basically under the basic indicator approach, clear. Under the basic indicator approach, the capital charge for the operational risk, clear. The capital charge for the operational risk is calculated as -% of average gross annual income, average of gross income over the 3 years, clear. Under the basic indicator approach, the capital charge for the operational risk is calculated as -% of average gross income, basically over the 3 years, clear. Over the 3 years, clear. So basically when this type of question is asked in the examination, you have to understand, clear. Basically this question they have asked from the chapter number 13, clear, because under the chapter number 13 basically we have discussed the operational risk and the basic indicator approach, clear. So at that time basically we have discussed that it is to be 15%, clear, that it is to be basically 15% of the average gross income, clear, of the average gross income over the 3 years, clear, over the 3 years. And one condition more, that is the average, that is the gross income for that particular year, that is the gross income for that particular year, clear. Basically for that particular year is to be greater than, or basically is to be greater than 0, clear, not equal to, is to be greater than 0, clear. That figures for any year basically in which the annual gross income is negative or 0, clear, should be excluded, clear. So basically the gross income for that particular year is to be greater than 0, clear, is to be greater than 0, clear. This thing basically you have to also remember that, clear, not equal to or not less than, clear. Basically it should be greater than 20, clear. It should be greater than 20, clear. Only in that case basically we have to include that, clear. Only in that case basically we have to include that. So next one is the standardized approach, clear. Next one is the standardized approach, clear. Now basically we have to discuss on that, clear. Standardized approach, clear. So basically in the standardized approach, banks activities are basically divided into the 8 business lines, clear. In the standardized approach basically banks activities are basically divided into the 8 business lines, like corporate finance, trading and sales, retail banking, commercial banking, payment and settlement, agency services, asset management and retail brokerage, clear. Basically under these 8 basically they have to be divided, clear. Further, basically within each business line, clear, basically within each business line, gross income is a broad indicator, clear, that serves as a proxy for the scale of the business operations, clear. Basically within each business line, clear, basically under these 8 business lines, they are saying that within each business line, gross income, it is a broad indicator that serves as a proxy, clear. Basically that serves as a proxy for the scale of business operations, clear. Basically gross income is a broad indicator that serves as a proxy, clear. Basically that serves as a proxy for the scale of business operations, clear. Basically for what? For the scale of business operation, and thus the likely scale of operational risk exposure within each of these business lines, clear. Basically and thus the likely scale of operational risk exposure basically within each of these business lines, clear. Basically they have specific mention that under this business line basically we will face this much type of basically risk, clear, up to this much level we can face. So the capital charge for each business line, clear, the capital charge for each business line is calculated by multiplying the gross income by a factor, clear. Basically by multiplying the gross income by a factor, like basically we can say that 1000 crore, clear. Basically specific gross income, clear, in that specific business line, clear, in that specific business line, clear. So what is the capital charge, clear? What is the capital charge basically for that specific business line, clear? That is to be donated as beta assigned to that business line, clear, assigned to that business line, clear, beta factors, clear. So basically there are 8 business lines, so basically 8 beta factors, clear, has to be assigned, clear. 8 beta factors basically has to be assigned. So let's discuss one by one, clear. So business line beta factors, clear, this is 1, this is 2, Clear. First of all, basically we will write 8 beta factors. Clear. 8 business lines. So basically we will find that either basically there is 18% figure, there is 12% figure, or there is 15% figure. Clear. Only 3 figures basically we will see here. Clear. Only 3 figures basically we will see here. Clear. So now basically what is the capital charge? Clear. Basically for the corporate and finance, for corporate, for second one is for trading, and third one is basically for the payment and settlement. Clear. Basically for the payment and settlement. Clear. Under that, basically what is the capital charge? That is 18%. Clear. 18%. Clear. Beta factor, that is 18%. Clear. So if that basically specific gross income or business basically of 100 crore. Clear. So basically under the corporate, basically how much basically we have to take as a capital charge? That is 180 crore. Clear. That is 180 crore. Directly 18%. Clear. Directly 18% of the total. Clear. Directly 18% of the total. Clear. So under the corporate finance, clear, corporate basically we consider big form. Clear. So trading and sales. Trading is also basically we consider that of shares. Shares is of basically of what? Basically of corporate. Clear. So basically that are also related to that. Clear. And payment and settlement. Clear. So basically when we are doing the share trading, clear. So basically we will need to the payment transfer on the spot and settlement of that also. Clear. So that basically we can purchase the share. Clear. So please link this type of story in that way. Clear. So that you are able to remember that all are linked to the 18%. Clear. That corporate basically we can say trading basically we can say payment and settlement. Clear. Trading basically we can say that payment and settlement. Clear. Trading basically relates to the payment and settlement. So all are related to the 18%. Clear. All are related to the 18%. Clear. So you have to remember all these things. Clear. You have to remember all these things. Clear. Next one, that is 15%. Clear. 15%. That is commercial banking and agency services. Clear. Commercial banking and agency services. Clear. All are related to the 15%. Clear. Commercial banking and agency services. Clear. All are related to the 15%. And rest one, this retail banking, normal banking, asset management, retail banking, asset management, and retail brokerage. Clear. So basically you have to remember that retail is related to the 12%. Clear. Retail is related to the 12%. Clear. Retail banking, retail brokerage, and asset management. Clear. And asset management. Clear. All are related to the 12%. Clear. Only agency services and the commercial banking. Clear. Corporate is big, and after that basically we can see that commercial, that is 15%. Clear. Last one is the retail. Clear. Last one is the retail, that is least risk. Clear. Under that is 12%. Clear. That is 12%. Clear. So in this way basically you have to learn this beta factors. Clear. And I request to all of you, please learn this beta factors, because they will ask directly 1 mark question. Clear. Directly 1 mark question. Clear. Basically what is the beta factor in the agency services? Clear. Or what is the beta factor basically in the retail brokerage? Clear. So basically you have to remember all these things. Clear. Just basically follow the basic way. Clear. To understand, basically make a story or any other way, so that basically you have to remember. Clear. So that basically you have to remember. Clear. Our main motive is to remember these things. Clear. Basically our main motive is to remember these things. Now next one is the third approach. Clear. Now next one is the third approach, that is advanced measurement approach. Clear. Advanced measurement approach. And basically we have already discussed. Clear. That the first two approaches, that is based on the income generated. Clear. That is basically based on the income generated. BIA, basic indicator approach, and TSA, that is the standardized approach. Clear. Now third one is the advanced measurement approach. Clear. Advanced measurement approach. Clear. So under the advanced measurement approach, the regulatory capital requirement will equal the risk measure. Clear. Basically under the advanced measurement approach, the regulatory capital requirement will equal the risk measure generated by the bank's internal operational risk measurement system. Clear. The advanced measurement approach. Clear. Basically under the advanced measurement approach, the regulatory capital requirement basically will equal the risk measure generated by the bank's internal operational risk measurement system. Clear. Using the quantitative and qualitative criteria. Clear. Basically using the quantitative and qualitative criteria basically for the AMA. Clear. Basically for the advanced measurement approach basically discussed below. Clear. So what is the criteria? Basically we have to discuss in detail. Clear. Basically what is the criteria? Clear. Under the advanced measurement approach. Clear. To measure the capital requirement. Clear. To measure the capital requirement, basically we have to use quantitative as well as qualitative. Clear. So basically whenever they will say that quantitative. Clear. So basically we can say that there is some numerical discussion. Clear. There is some numerical discussion. So a generic measurement approach. Clear. Generic measurement approach. Clear. Under the AMA. Clear. Under the AMA, that is advanced measurement approach. Clear. So the first step in measurement approach. Clear. The first step basically in the measurement approach is operation profiling. Clear. The first step basically in the measurement approach basically it is the operation profiling. Clear. Is the operation profiling. Clear. So what are the steps involved in the OP? operation profiling are clear. Operation profiling are, first one is identification, clear. First of all, basically we have to identify, and quantification of operational risk basically in terms of its components, clear. In terms of its component, clear. First of all, basically we have to identify and quantification, clear. Identification and the quantification of the operational risk, clear. Identification and quantification of the operational risk basically in terms of its components, clear. In terms of its components, clear. Second one is prioritization of the operational risk, clear. Basically, first of all, basically we have to identify different, so basically we have to prioritize, clear. Basically we have to prioritize, clear. Basically which one is more important and which one is less important, clear. All are to be important, just basically we have to prioritize, clear. Basically which one is more important and which one is less important here, clear. So prioritization of the operational risk, clear. Prioritization of the operational risk and identification of risk concentration, clear. And identification of risk concentration, that is hotspots resulting in lower exposure, clear. That is hotspots basically resulting in the lower exposure, clear. Just basically we have to do prioritization of the operational risk, clear, and identification of the risk concentration, clear. Identification of the risk concentration, clear. Third one is basically formulation of the bank strategy. Formulation of the bank strategy basically for the operational risk management and risk-based audit, clear. For the operational risk management and the risk-based audit, clear. Third one is basically formulation of the bank strategy, clear. Formulation of the bank strategy basically for what? For the operational risk management and the risk-based audit, clear. And the risk-based audit, clear. That is formulation of the bank strategy, clear. Basically how we can formulate, clear. Basically how we can measure the operational risk, clear. So the estimated level of operational risk is basically depends upon, clear. You have to remember these things, clear. So the estimated level of operational risk, clear. Estimated level of operational risk basically depends upon estimated probability of occurrence, estimated potential financial impact. Third one is estimated impact of internal control, clear. Third one is basically estimated impact of the internal controls, clear. Estimated impact of the internal control, clear. So you have to remember all these things, clear. You have to remember all these things. Estimated level of operational risk basically it depends upon, first one is estimated probability of occurrence, second one is basically estimated potential financial impacts, third one is basically estimated impact of the internal control, clear. Basically estimated impact of the internal control, clear. Basically you have to remember all these things, clear. Probability of occurrence, potential financial impact, clear. Basically first one is occurrence, second one is financial impact, clear. What is the impact on that? Third one is basically impact of internal control, clear. Estimated impact of internal control, clear. All these things basically you have to remember here, clear, under the estimated level of operational risk. Now what is basically we have to discuss in detail all these things, clear. First one is estimated probability of occurrence, clear. That is basically depends upon, clear. So this will be basically based on the historical frequency, clear. Basically this will be based on the historical frequency of occurrence and estimated likelihood of future occurrence, clear. First of all, basically this will be based on the historical frequency of the occurrence, clear. Historical frequency of the occurrence and estimated likelihood, clear. Basically and estimated likelihood of future occurrence, clear. And estimated likelihood of future occurrence, clear. So probability is mapped, clear. Basically probability is mapped on a scale of 5, clear. Probability basically it is mapped on a scale of 5. Basically we can say that scale of 5, like this one is 1, this one is 2, this one is 3, this one is 4, this one is 5, clear. So probability is mapped basically on a scale of 5. Basically we can say that where 1 basically just basically we can say that this type of indication, clear. So 1 basically we can say that implies negligible risk, clear. Basically 1 implies that very negligible risk, 2 basically implies that low risk, 3 basically implies that medium risk, 4 implies that high risk, and 5th implies that very high risk, clear. 5th implies that basically very high risk, clear. So basically we have to differentiate according to that, clear. Or basically we have to differentiate according to that, so that basically we are able to understand, clear. So that basically we are able to understand, clear. Estimated probability of occurrence, clear. Basically it is divided, basically probability is mapped on a scale of 5, clear. On a scale of 5. So basically we can say that medium one is a medium risk, clear. Medium risk, clear. Above that basically low risk, and below that basically high risk, clear. Sometimes basically they will ask, clear, medium, above that low risk, below that high risk, clear. And above below risk, negligible risk, negligible risk, clear. Negligible, GI, negligible risk, clear. And below high risk, that is very high risk, clear. That is very high risk, clear. So basically you have to remember all these things, clear. Medium one is a medium risk, Above that low risk and below that high risk, clear, and above that basically negligible risk and below that basically very high risk, clear, basically very high risk, clear. That is basically estimated probability of occurrence. Next one is estimated potential financial impact, clear, estimated potential financial impact, clear, that is how much financial impact basically they can bear, clear, how much financial impact basically they can bear, that is estimated financial impact, clear, that is estimated financial impact, potential financial impact, clear. So basically this will be based on a severity of historical impact and estimated severity of impact basically from the unforeseen events, clear. Unforeseen events, like basically we can say that basically due to the COVID, clear, that is basically one of the unforeseen, clear, that is unforeseen events, clear, that is the impact of. So basically this will be based on severity of the historical impact and estimated severity of impact basically from the unforeseen events, clear, from the unforeseen events, clear. So probability here is also basically mapped on a scale of 5, clear, on a scale of 5, basically how, clear. Wait a minute, I think there is some estimated probability of occurrence, and next one is the basically estimated probability potential impact, clear, estimated potential impact, clear, estimated potential impact, clear, clear. Next one is estimated impact of internal control, clear. Next one is basically estimated impact of internal control, clear. Here just you have to go through up to this one. This one is not clear. Estimated impact of the internal control, clear, estimated impact of the internal control, clear. So this will be based on the historical effectiveness, clear, basically this will be based on the historical effectiveness, clear, basically this will be based basically on the historical effectiveness of internal control and estimated impact of internal control on the risk, clear, and estimated impact of the internal control on the risk, clear. So this is estimated as fraction, clear, basically this is estimated as fraction, clear. So basically first two, clear, basically first two, this one and this one, clear, basically that is based on the probability, clear, that is basically based on the probability, clear. This one basically probability is mapped on a scale as mentioned above, clear, basically on the basis of that, clear, just on the basis of that. There is not any new guidelines, clear, just basically potential financial impact, that is either this one, 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 clear, because they are mentioned above, clear. Same basically on the basis of that, clear. Here estimated impact of the potential internal control, clear, of the internal control, that is basically this will be based on the historical effectiveness of internal control and estimated impact of the internal control on a risk, clear. So this is estimated as fraction, clear, out of 100%, basically this is estimated as fraction, clear. So you have to remember a probability of occurrence, basically that is basically mapped on the scale of 5, clear, 1 2 3 4 5. Similarly, estimated potential financial impact, this is also basically mapped on the scale of 5, basically on these 5 factors, 1 2 3 4 5, clear. And third one is that is the estimated impact of internal control, basically this is basically based on the percentage, clear, basically this is based on the percentage or on the fraction, clear, or on the fraction, clear. So basically how we can calculate the estimated level of operationals, clear, how we can calculate the estimated level of operationals, basically estimated probability of occurrence into estimated potential financial impact into estimated impact of internal control, clear, into impact of internal control, clear. Basically we have to multiply all these three ones, clear, all these three ones, clear. So basically what in the general way, clear, basically how we can calculate, basically let's understand basically with this example, clear. That is the probability of occurrence, that is 2, potential financial impact, that is 4, clear, very high, this is to be medium. Impact of the internal control, that is 50%, clear, that is 50%, or basically we can say that 0.50. 0.50, clear, 50 upon 100, that is 0.50. So what is the estimated level of operation is, clear, basically first of all basically we have to multiply these two, 2 into 4, and then last one, that is 50%, either basically we will write 50% or basically we can take in the form of fraction, that is 1 minus 0.50, clear. If it is given as 20%, so basically we will subtract as 1 minus 0.20, clear, and overall under root of that. So 8 into 0.50 upon 100, 1 2, this is 1 or 4, clear. So estimated level of operation is to be 2, clear, estimated level of operational is to be 2, that is low, clear, that is low, clear. So estimated level of operation is basically we can say that comes out to be 2, that is to be low, clear, that is to be low, clear. So basically in this way basically we have to calculate this one, clear. Sometimes basically they will ask this type of question, that is probability of occurrence, that is 2 medium, Potential financial impact, that is 4, very high. Impact of the internal control is 50%. Clear? Is a 50%. Clear? Just basically we have to take it as a fraction and subtract it from 1. Clear? And subtract it from 1. Clear? So basically in this way. Clear? In this way, basically you have to able to answer the question. Clear? Basically you have to able to answer the question. Clear? So let's discuss one question on the same concept. Clear? So let's discuss basically one question on the same concept. And I request to all of you, clear? And I request to all of you, please answer the question. Clear? Please answer the question. Clear? That is also totally hypothetical question. Clear? That is also totally hypothetical question. Clear? Just basically on the scale of 5, just basically this is also hypothetical question. Clear? Hypothetical question. Clear? Not lit. Just basically you have to implement the formula here. That is probability of occurrence is equal to 6. Clear? That is probability of occurrence is equal to 6. Potential financial impact is equal to 8. Clear? Potential financial impact is equal to 8. And impact of the internal control is 40%. Clear? And impact of the internal control is 40%. Clear? So what is the estimated level of operational risk? Clear? What is the estimated level of operational risk? Clear? So please tell fast what is the answer of that. Clear? So please tell fast what is the answer of that. Clear? Just basically this is a hypothetical question. Basically to implement the formula. Clear? That's why basically we will discuss it. So estimated level of operational risk is equal to square root of 6 into 8 into 1 minus 0.40. Clear? Into 1 minus 0.40. 6 into 8 basically comes out to be basically 48 into 0.60. So 48 into 0.60. This comes out to basically 28.8. Square root of that. This comes out to basically we can say that 5.366, which is basically we can say that 5.37. So basically this one is the answer. Clear? So this one is the answer. Clear? So basically this type of question basically they will ask in the examination in the form of 1 mark. Clear? In the form of 1 mark. Clear? Just basically what you have to do, basically you have to understand. Clear? Basically you have to understand the formula, or basically you have to remember the formula in the examination, so that basically you are able to answer the question. Clear? You are able to answer the question. Clear? Basically this is a totally hypothetical. Clear? Because we have to measure basically on the scale of 5. Clear? On the scale of 5. Basically just how to implement the formula. Clear? Basically this type of question basically we will discuss with you. Clear? We will discuss with you. So please tell fast it is clear to all of you basically what we have discussed up to this much point. Please respond fast. Clear? So basically we will discuss regarding all the approaches. Clear? First one is the basic indicator approach. Second one is the standardized approach. Third one is the basically we can say that advanced measurement approach. Clear? And after that basically we have to also able to calculate, that is estimated level of operational risk. Clear? That is estimated level of operational risk. Clear? Now last one basically just one point basically we have to understand, that is integrated risk management. Clear? Basically integrated risk management. Clear? So basically what is integrated risk management? Basically when all the risk basically we have to manage collectively. Clear? Basically integrated risk management basically we can say that basically when all the risk basically we have to manage collectively, that is basically comes under the integrated risk management. Clear? That is basically comes under the integrated risk management. Clear? Basically like basically we can say that basically there are different types of risk, that is liquidity risk, interest rate risk, market risk, credit risk, operational risk. Clear? So basically when we are able to measure all the risk collectively, that is basically comes under the integrated level risk. Clear? That is basically we can say that integrated risk measurement. Clear? That is basically we can say integrated risk management. Clear? So we know that. Clear? We know that basically the profit and loss of an organization, it is the sum total of all profit and losses. Clear? That are generated through various activities. Clear? Basically we know that the profit and loss of an organization, basically it is the sum total of all the profit and losses basically that are generated basically through various activities. Clear? Similarly, total risk of an organization. Clear? Basically similarly the total risk of an organization is also the net effect of all risk basically that are to be associated basically with the activities undertaken throughout the organization. Clear? Similarly, the total risk of an organization are also the net effect. Clear? Basically are also the net effect of all the risk. Clear? Like profit and loss basically it is the net effect. Clear? That is a net of all the profit and losses. Similarly, the risk is also the net effect basically of all the risk basically that are associated with the activities undertaken throughout the organization. Clear? Undertaken throughout the organization. Clear? Undertaken throughout the organization. But net effect of all risk may not be the same. Clear? Basically, but net effect basically of all the risk basically may not be the same as sum total of all risk. Clear? Basically as sum total of all risk, as it is basically in the case of profit and loss. Clear? As it is in case of profit and loss. Clear? Because the risks are well diversified. Clear? Basically because the risks are well diversified, and it is very difficult to measure. Clear? And they are very difficult to measure. Clear? So basically we have to take care regarding that also. Clear? Basically we have to take care regarding that also while doing these things. So but net effect, clear? Basically but net effect basically of all the risk, clear? Basically but net effect basically of all the risk be the same. Clear? May not be the same. Clear? Basically may not be the same as sum total of all risk. Clear? Basically may not be the same as sum total of all risk as it is the case in the profit or loss. Clear? This is basically because of the diversification effect. Clear? Basically this is because basically of the diversification effect of the risk, that is diversification effect for similar risk and interplay and correlation basically between various types of risk. Clear? Therefore when we talk of integration of risk, clear? Basically when we talk of integration of risk, basically it does not simply imply an accounting approach to it. Clear? Rather it implies a coordinated approach, clear, across various risks and various diversification opportunities that exist and that may be created in an organization. Clear? Like basically we can say that basically in simple terms, like in the case of profit and loss. Clear? Basically basically we will calculate the numerical values. Clear? Just basically we will create the numerical values and try to overall profit and loss of an organization. Clear? But in the case of risk, clear? Basically but in the case of risk, basically we will not do that. Clear? Basically we will not do that. Clear? That is numerical calculation of the risk. Clear? Just basically we have to analyze that. Clear? Basically we have to also analyze that. Clear? Because some risk basically we cannot measure in the form of numerical values. Clear? In the form of numerical values. Clear? So to basically measure all the risk basically in a collective place, clear, that is basically known as the integrated risk management. Clear? Basically to manage all the risk collectively. Clear? To manage all the risk collectively, that is basically comes under the integrated risk management. Clear? Integrated risk management. Clear? Basically for that basically there is an approach is to be applied. Clear? Basically full process is to be implemented. Clear? So the process of integrated risk management basically consists of basically strategy, organization. Clear? Basically under the organization basically they have to do establishment of the chief risk officer. Clear? You have to remember that. Clear? Here this one is the important, that is basically for the integrated risk management approach. Clear? Basically establishment of the chief risk officer position with his or her accountability basically to the board of directors. Clear? Because this one is the person. Clear? This one is the position that has the responsibility. Clear? Basically for the overall risk management. Clear? Basically for the overall risk management and has accountability. Clear? Basically we can say that and has the responsibility to manage that, and this person is also the reporting authority. Clear? Basically the reporting authority basically to the whom? To the board of directors. Clear? To the board of directors. Clear? So as a part of the effective risk management, clear, this one is very, very important. Clear? That's why basically we are discussing here. As a part of the effective risk management, clear, basically RBI has advised the banks to have a system of separation credit risk management function from the credit sanction process. Clear? Basically as per the RBI guidelines, basically for effective risk management, basically RBI has advised the banks basically to have a system of separation of credit risk management function from the credit risk sanction. Clear? Basically they can say that basically they are separate authorities. Clear? Basically for the credit, basically for the loan sanctioning and for the loan monitoring. Clear? Basically we can say that just simple language, basically for the loan sanctioning and for the loan monitoring there may be different persons. Clear? There may be different person basically for the effective risk management. Clear? Basically for the effective risk management. Clear? That is basically separation of the credit risk management function basically from the credit risk sanction process. Clear? From the credit risk sanction process. Clear? So basically RBI has advised the banks. Clear? Basically wide guidelines of April 2017 as under, that is bank should appoint a chief risk officer. Clear? That is bank should appoint a chief risk officer. Bank should lay down a board or approved policy clearly defining the role and responsibilities of the chief risk officer. Clear? Basically clearly defining the role and responsibilities of the chief risk officer. Clear? Of the chief risk officer. Clear? So basically bank should lay down a board approved policy basically clearly defining the role and responsibilities of the chief risk officer. CRO, chief risk officer, basically has to control and coordinate. Clear? Basically chief risk officer basically has to control and coordinate the function of the risk management department of the bank. Clear? Basically chief risk officer basically has to control and coordinate the function of the risk management department of the bank. Because of the importance basically RBI gives to this post, RBI has made CRO basically to report directly to the MD or CEO of the bank. Clear? Very, very important post, that is basically they have to respond or report directly to the MD or CEO of the bank. Clear? So basically here just basically important question regarding the chief risk officer. Clear? Basically what type of question basically you will get in the examination, that is Basically whom they have to report, clear? Basically whom they have to report, basically they have to report directly to the CEO, clear? Basically to the CEO, or basically we can say that to the managing director, clear? To the managing director of the organization, clear? Either basically they have to report to the CEO or basically to the managing director of the organization, clear? To the managing director of the organization, clear? So you have to take care of all these things and do revision of all these things, clear? So in this session, basically we have to discuss up to this much point, clear? In this session, basically we have to discuss up to this much point, clear? Whatever the topics basically we have discussed here, hope it is clear to all of you, and please remember these types of formulas, clear? Basically for calculating the answer, clear? For calculating the answer, clear? So thanks to all of you for joining this session, and this is also very, very important, clear? 15% of the previous, clear, of the average gross income basically over the 3 years, clear? Over the previous 3 years, and the gross income basically for that particular year basically is greater than 0, clear? For calculating the average, clear? For calculating the average, clear? So thanks to all of you for joining this session.